Hello, welcome. In this video, we will look at subsidiary for ACCA SBR group accounting basic groups in an exam-focused and simple way. A subsidiary is an entity that is being controlled by a parent, and a parent is an entity that controls another entity. And the parent is required to prepare consolidated financial statements which account for subsidiaries financial statements. We will see how the subsidiaries results are accounted in consolidated financial statements. The parent controls the subsidiary if the parent has power over the subsidiary and the parent is exposed or has rights to variable returns from its involvement with the subsidiary. Returns include a dividend and all that. Control is when the parent has ability to affect those returns through its power over the subsidiary. The power can be defined by exercise of majority of voting rights in the subsidiary, contractual agreements between the investor and other parties. Holding less than 50% of voting rights is still considered a power if with all other equity interests are held by a numerically large, dispersed, and unconnected group. Holding potential voting rights are also considered power if they are currently capable of being exercised. The nature of the parent's relationship with other parties that may enable the parent to exercise control over the subsidiary. Nature of parent's relationship. Accounting for subsidiaries in a basic group, which includes consolidated statement of financial position and consolidated statement of profit or loss. Firstly, we have to prepare the group structure, which include the share of parent in the subsidiary, the date, the acquisition and reporting date, and the setup pro forma group financial statement. This is the setup pro forma, which is very simple. We have to eliminate the carrying amount of parent's investment in the subsidiary, which will be around here. We have eliminated that and add together the assets and liabilities of the parent and its subsidiaries in full. We have added the assets, the liabilities in full. Include only the parent's balances within share capital and share premium. We have included only the parent's share capital and share premium. And for group reserves, which are retained earnings and other components of equity, and NCI and goodwill, we had to do separate calculation, which are in the appropriate workings. Working 3, working 4, and working 5. So working 2 looks at group reserves, which include subsidiaries' net assets at acquisition date and at the reporting date. We will be using subsidiaries' net asset at acquisition date for goodwill, and we will be using the movement in net asset at acquisition and at a reporting date to calculate NCI and group reserves. In the consolidated statement of financial position, the net assets of subsidiary, which is usually retained earnings and other components of equity, will be taken from reporting date after adjustments of fair value, PRP, and all the other adjustments. So at the acquisition date, to the retained earnings of the subsidiary, we will be adding fair value adjustments. At the reporting date also. At the reporting date, we will be deducting post-acquisition depreciation or amortization amount on the fair value adjustments, and we will be deducting PURP if the subsidiary is the seller. And as we know, we will remove the goodwill in the accounts of subsidiary, which won't be recognized in consolidated financial statements. We will only recognize goodwill calculated on acquisition. Goodwill in the accounts of subsidiary is usually internally generated, so we won't be taking it. Now that we have calculated group reserves, we will be looking at goodwill calculation. Goodwill is calculated by fair value of consideration plus NCI at acquisition minus fair value of net asset at acquisition. And then we remove impairments of goodwill to date. There is a note: if full goodwill method is being adopted, then NCI value will be normally given in the question, which is fair value of NCI at the date of acquisition. And if proportionate goodwill method is being adopted, then the NCI value will be the share of fair value of subsidiaries net asset at acquisition, which is usually the share price of NCI times the number of shares held by NCI. Now let's calculate NCI, which is the NCI value at acquisition, which we mentioned we can calculate by full goodwill method or by proportionate goodwill method. And then we add NCI share of post acquisition movement in net assets, which is usually the share of subsidiaries net assets, which is usually the NCI share of post acquisition movements in retained earnings and the other reserves, and less NCI share of goodwill impairment if fair value method is used. If proportionate goodwill method is being used, then we don't deduct goodwill impairment. Now let's calculate reserves from the net asset at acquisition and net asset at reporting date. We take 100% of parents' retained earnings, and then we take each subsidiary's group share of post-acquisition retained earning, which we calculated at the beginning, and then we take gain on bargain purchase if there is a negative goodwill. Then we deduct goodwill impairment. We deduct the whole impairment if we calculated proportionate goodwill method, but if we calculated NCI at fair value, then only parents' share of goodwill impairment is deducted from retained earnings. And we deduct PURP if the parent was the seller. Remember, we deducted PURP if the subsidiary was seller from the net assets of subsidiary at reporting date. Now, other components of equity, we use the same way we calculated in retained earnings. That is, we add group share of post-acquisition other components of equity for each subsidiary to the parent's other components of equity. So now let's look at the consolidated profit or loss and other comprehensive income. So we have to set up the group structure first, which is usually parent share in subsidiary, the acquisition date, the reporting date, and then we set up the pro forma group statement of profit or loss and other comprehensive income, which is this one. We add the revenue and expenses of both parents and subsidiary in full, and where the subsidiary is acquired in the middle of the year, we only take post-acquisition revenue and post-acquisition expenses. So for cost of sales, we had to add excess depreciation, PURP, if parent is the seller, and we less the intra purchases. We deduct the intra revenue. The journal entry for goodwill impairment is debit P&L and credit goodwill, and NCI if NCI was calculated at fair value method. For intra revenue and for intra purchases, the double entry is debit revenue and credit cost of sales. And for PRP, if the parent is the seller, the double entry is debit cost of sales and credit inventory. Under investment income, we have to add the profit or deduct the loss from the recognition of equity investment, which is usually the disposal of associate, subsidiary, or whatever. We also shouldn't include the dividend received from subsidiary because it will cancel out. And the same goes for other comprehensive income, where we add parents and subsidiaries other comprehensive income. After profit for the period, we have to classify the profit to the group and to the NCI, and then we attribute other comprehensive income to the group and to the NCI. So this is how it looks like: revenue to then operating profit to then profit before tax to then profit for the year, and then we attribute a profit for the year to group and NCI, and then we go directly to consolidated statement of other comprehensive income. From there we go to the profit, other comprehensive income, and then we go to the items that will not be reclassified to P&L and items that will be reclassified to P&L subsequently. And then we go to other comprehensive income, net of tax, and total comprehensive income for the period. And then we attribute the total comprehensive income to group and NCI. For the statement of profit or loss, we have to prorate the results of subsidiaries so that only post-acquisition incomes and expenses are consolidated, and we have to eliminate the intra-group income and expenses PURP on intra-group transaction as well as dividends received. And then we complete the pro forma and calculate the profit and total comprehensive income attributable to the NCI. We had to take the profit or total comprehensive of the subsidiary for the year, prorated if it is mid-year acquisition, and then we less PRP if the subsidiary is a seller, and we less excess depreciation or amortization, and then goodwill impairment if fair value method for NCI was used. The double entry for PRP is debit P&L for subsidiary, credit inventory. And then after we get the amount, we had to take the NCI percent. After that, we deduct NCI percent from the subsidiary's profit to get what is attributable to the parent. So that's all for this video. I hope this explanation was helpful. Thank you for watching. Disclaimer: